So the Federal Reserve just cut interest rates because they are terrified of what is potentially going to happen in 2026 at a time that the stock market's at all-time highs, at a time that AI is just going out the wazoo, going to the moon. It's setting up a potential perfect storm.
But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance.
So I want to make this extremely clear. The Federal Reserve's job is to keep inflation low and keep the labor market strong. We want to have a strong economy, but we don't want to have runaway inflation.
If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. But as I mentioned, going forward is a different thing.
So take a look at this chart right here. It shows you that the Fed's inflation target is, of course, 2%, as everybody knows. Came out of COVID, inflation went way up, we raised interest rates, inflation came down, we get it. But look at what's happening right now. Do you see this inflation ticking back up? We were pretty close to the 2% target. Then tariffs came, then various other things happened in the economy that caused inflation to come back. And you can see we're now basically back up at 3% for headline CPI. This is what's worrying Jerome Powell, because not only do we have to juggle an economy that is slowing down, but we have inflation that is on the rise. And if we take a look at this chart here, you could just see that in April of 2023, the unemployment rate was roughly 3.4%, and now it's on the incline going all the way up to 4.3%. So a clear and definitive trend going up on the unemployment rate. And on top of that, people that are getting laid off, it's harder for them to find work because this is the job openings rates by industry. So you could see since basically 2022, new job postings have been on a clear decline for pretty much every single sector out there. Maybe this is because of AI, maybe it's because of immigration, maybe it's because we just overhired people coming out of COVID, and now it's like, maybe we don't need this many people. So it's kind of like Jerome Powell's hands are tied behind his back, because it's like, if you cut interest rates, you're probably going to make inflation worse. But if you don't cut interest rates, we might go into a full-blown recession. And on top of this, the stock market is at an all-time high and valuations are at an all-time high right now too, pretty much on par with what happened in 1999. So are we setting ourselves up for this perfect storm, or is the Federal Reserve somehow going to cut interest rates just enough to save the economy, but not cut them too much to bring inflation back? Let's hear what he has to say.
We have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1.
So not only do we have to juggle this idea of saving the economy and saving inflation from going to the moon, we have to juggle this internal debate with Fed officials saying, hey, I think rates should go down. Hey, I think rates should go up or stay flat. That's what Jay Powell's talking about, where there's very strong opinions, and it's not guaranteed that we are going to get a December interest rate cut. Now, the stock market is going to be not happy with that because interest rates are gravity on the stock market. And again, if we go back to this chart right here, you can see that valuations are, like I said earlier, right on par with 1999. In order to support this valuation, we need interest rate cuts, because as interest rates go down, stocks become more compelling, companies make more money, the economy does a little bit better. Overall, it's just good for the stock market. But Jerome Powell is saying that, hey, this December interest rate cut, it is not guaranteed because we are still worried about inflation and we still see significant headwinds for inflation. So we're juggling this two-sided debate of what the heck do we do right now? And the other critical thing he was talking about there with regards to reducing the balance sheet and securities holdings and stuff like that is that they are done doing quantitative tightening. And quantitative tightening basically just means that they are sucking money out of the system. So now that they are done sucking money out of the system on December 1st, what does that mean for the stock market? Well, it could be good for the stock market because there's going to be more liquidity back in the system or just less being taken out. But at the same time, that could again cause inflation. And if we don't keep this in check, inflation could get right back out of control how we were before. And like everyone's pricing in this idea that we're still probably going to get this December interest rate cut. But what if we don't get it? And then what if inflation keeps coming back? And then what if early in 2026, which we're going to build on this in just a second, which is the title of the video, 2026 will be terrifying. There's this idea that what if inflation does come back? And maybe we actually have to raise interest rates. Think about that. Like, let's take a look here at what the stock market did when we had to raise interest rates on this most recent cycle. Let me flick this back right here. You can see what's going on. Triple Q. Take a look really quick. I know it's not the perfect chart, but just look really quick. You could see that from November 19th of 2021 until the bottom of the market, the NASDAQ fell roughly 34%. That was simply because interest rates went up. The valuation here versus here, like in 2022, the market was a little bit cheaper versus right now. So if we happen to have runaway inflation where we do have to raise interest rates, God, we are probably going to see a major issue for the stock market in 2026. And if you don't believe me about the valuation thing, let me flip back to it really quick. You could see that in 2022, the price earnings ratio level for the S&P was roughly 21. Right now, we're 24, getting close to 25. So perfection is priced into this market. And yes, I just went through a bunch of different companies. Most of them are reporting very, very good right now. But is this going to keep going? And are these companies actually going to keep laying people off, which is going to put even more pressure on the labor market? We just saw that Amazon is laying off tens of thousands of people. And in my opinion, it's only just getting started. So again, the economy might be doing good right now, but it might be artificially doing good because these companies are doing good. But once the layoffs start happening and maybe AI just gets so good that we just need less people to do the same amount of work, where are these people going to work? And you guys know my long-term thesis. I do think that the unemployment rate is going to go higher and higher and higher with time because AI is going to be so good and people just simply aren't going to be able to find a job as easily. So a reporter at the Wall Street Journal asked Jerome Powell, honestly, a pretty good question talking about, hey, do we really think that we're not going to cut at the December meeting because this market, it's kind of pricing it in right now. Like, we are probably going to need this cut or the stock market might do pretty bad. Let's hear what Jerome Powell has to say.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
So just think about this a little bit. The stock market is a big game of expectations versus reality. Like when companies go and report earnings and they beat the earnings estimates, the stocks will typically go up if the guidance is good and other stuff is good too. But it's just a game of expectations versus reality. So the expectation right now still for December is this. We are still projecting interest rate cuts in December. Now, if we don't get that, maybe the government shut down and there's different data that doesn't come out or whatever it may be, we might not be able to project as accurately what we think is going to happen. But if we go into December and Jay Powell's like, look, inflation's going up, we're not going to cut interest rates, we're going to stay higher for longer, and maybe we're going to actually raise interest rates if inflation gets out of control. Like, can you imagine what the stock market's going to do at the valuation level that it's at right now?
So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
2026 really could be bad for the stock market because we made this big move. And if we go into some sort of recession, it's like AI is just so good now and it's only going to get better. These CEOs are not going to be as willing to hire people back after all the layoffs happened. Like, look at what happened during COVID. Like, yes, the unemployment rate went up to like 15%. But all of those jobs got hired back and more. And if we just go to this posting right here, like, look at the job growth coming back out of COVID. But this is different in my opinion, because if we get a recession right now, it's like these CEOs are going to look at each other and be like, hey, yes, we could do more work with less people. Yes, the economy's crap, but we spent all this money on AI and we could go buy cloud compute from whatever the companies out there like CoreWeave or whoever. We're just going to use AI agents to replace these people instead of hiring so many people back, like what happened after COVID. Because after COVID, AI wasn't really that big of a thing yet. But right now, it is a big thing. And if this really does pan out like this could be very bad for 2026. And it could be a full blown recession that honestly might take years to dig out of it. And I do just want to have the final takeaway this. Nobody on planet Earth knows exactly what's going to happen in the economy and the stock market. I don't know. You don't know. Warren Buffett doesn't know. And neither does Jerome Powell. But something that we do know is this. Looking at this chart, this is not me picking and choosing data. This is cold, hard evidence saying that right now the stock market is expensive and you have to be very, very careful. Like, we're talking 1999, 2000 levels where the market fell 57%. Like, I'm not saying that is guaranteed to happen, but what I am saying is take a look at your portfolio right now. Are you over leveraged on plays that maybe they don't even make money, like quantum stocks or whatever the company is just crazy going to the moon that isn't really justified to be that high? Are you over leveraged? Do you have margin? Like, right now is a good time while the market's still at all-time highs to just de-risk your portfolio a little bit, because there are headwinds that are coming. And I want to say this last thing right here. I am extremely, extremely bullish the stock market in the long term, but short term, like the next couple years, I think there's going to be a lot of volatility and a lot of opportunity. And if you're prepared to capitalize and you're not over leveraged right now, you are going to have money on the sidelines, whether it's cash or just margin buying power, to be able to capitalize on those dips. So have a little bit of money on the sidelines, put a little bit of money somewhere safer right now, so that when we do get volatility and we do get sales and discounts, you could buy shares, you could buy calls, and you could sell puts. So if you got value from this video, definitely go like and subscribe. It really helps out the channel a lot, because I put a lot of time and energy into these videos to try to give you my unbiased opinion of how I scaled to a couple $1,000,000, how you guys could do it too, and really just focused on the needle movers. Like, I'm not trying to clickbait you into these videos and get you to watch until the end. I'm just trying to give you the information that I am personally looking at and I'm using to invest based on, so that we could just make more informed investment decisions. Because again, I'm here to make money and you're here to make money too. So with that being said, watch this video right here. It's the companies that are probably going to do very, very well if we get this market crash in 2026. I'll see you there.